Warren Buffett, the Oracle of Omaha, is a legend in the world of finance. He's known for his investing prowess, his folksy wisdom, and his uncanny ability to predict market trends. But recently, he's made a move that has the entire financial world buzzing with speculation and intrigue. Buffett's company, Berkshire Hathaway, is currently sitting on a mountain of US debt. And we're not talking about a small pile either. We're talking about a staggering $234.6 billion worth of US Treasury bills. To put that into perspective, that's more than the Federal Reserve itself holds. So, what does Buffett know that we don't? What insights does he have? Is this a vote of confidence in the resilience of the US economy? Or is it a subtle warning sign that we might be headed for financial trouble? The answer, as with most things in finance, is complicated and multifaceted. One thing is certain. When Buffett makes a move, the world takes notice. And this particular move has the potential to send shockwaves through the global economy, affecting markets far and wide. So buckle up, because we're about to dive deep into the world of high finance and figure out what it all means for you, the everyday investor. Let's break down this massive pile of US debt that Buffett is hoarding. We're talking about US Treasury bills, or T-bills for short. These are short-term debt securities issued by the US government. They're considered one of the safest investments in the world. When you buy a T-bill, you're essentially loaning money to the US government. And in return, the government promises to pay you back the principal plus a little bit of interest. The interest rate on T-bills fluctuates based on a variety of factors, including inflation and the overall health of the economy. Buffett's massive stake in T-bills is significant for a couple of reasons. First, it shows that he's bullish on the US dollar. He's essentially betting that the dollar will hold its value, even in the face of inflation. Second, it suggests that he's not finding a lot of other attractive investment opportunities in the current market. Here's where things get really interesting. Imagine the ripple effects. What happens if Buffett decides to sell a large chunk of his T-bill holdings? This is a scenario that could shake the financial world. Well, the impact could be significant, potentially altering market dynamics. Remember, when you sell a bond, you're essentially trying to find someone else to take your place as the lender. It's a delicate balance. And if a lot of bonds are being sold at once, it can drive down the price of those bonds. This could lead to a chain reaction. If the price of US Treasury bonds were to drop significantly, it could have a ripple effect throughout the economy, affecting various sectors. Interest rates would likely rise, making it more expensive for businesses to borrow money and invest. This could stifle innovation and expansion. This could slow down economic growth and potentially even lead to a recession, impacting jobs and livelihoods. Now, it's important to note that Buffett is a long-term investor. His strategies are well thought out. He doesn't make rash decisions. His moves are calculated and deliberate. So it's unlikely that he would suddenly dump all of his T-bills on the market. Such a move would be out of character. But even the possibility of him selling a portion of his holdings is enough to make investors nervous. The market watches his every move closely. The Federal Reserve, or the Fed, is the central bank of the United States. It has a mandate to keep inflation in check and promote maximum employment. This dual mandate is crucial for maintaining economic stability and ensuring that the economy grows at a sustainable pace. One of the Fed's main tools for doing this is setting interest rates. By adjusting these rates, the Fed can influence borrowing costs, consumer spending, and overall economic activity. Recently, the Fed has been raising interest rates in an attempt to combat inflation. This strategy aims to cool down an overheated economy and prevent prices from spiraling out of control. This has made borrowing more expensive, which is supposed to slow down the economy and bring inflation under control. Higher interest rates mean higher costs for loans, mortgages, and credit, affecting both consumers and businesses. However, it's a delicate balancing act. The Fed must carefully calibrate its actions to avoid unintended consequences. Raise rates too quickly, and you risk triggering a recession. A sudden economic slowdown can lead to job losses and reduced consumer spending, creating a negative feedback loop. Buffett's strategy, on the other hand, seems to be to park his cash in safe, short-term investments like T-bills while he waits for more attractive opportunities to emerge. This conservative approach helps preserve capital and provides liquidity. He's not trying to time the market or predict the future of interest rates. Instead, he focuses on long-term value and waits for the right conditions to invest. He's simply being patient and waiting for the right moment to strike. This patience is a hallmark of his investment philosophy, so who's got the right approach? Only time will tell. The effectiveness of these strategies will depend on how the economic landscape evolves. But it's fascinating to watch these two titans of finance grapple with the same economic challenges. Their differing approaches offer valuable insights into the complexities of economic management and investment.